Incremental cash flow is the additional money a company expects to gain or lose from a specific project or business decision. In finance, we focus on the word incremental because it measures the change caused by a single choice, not the whole business. To calculate it, simply compare the company's future cash flow with the new project against what it would be without that project. Include all relevant cash movements, like initial equipment purchases, daily operating gains, and even lost opportunities from other potential projects. Always exclude sunk costs, which are expenses already paid that cannot be recovered regardless of whether you move forward with the project. Projects often start with a cash outflow to build or buy assets, followed by expected inflows as the project generates revenue. Remember that cash flow is king. Accounting profit can be influenced by non-cash items, but cash flow tracks actual money in the bank. By isolating incremental cash flows, businesses make better-informed investment decisions. Thanks for watching, and stay tuned for more finance basics.